This week, the world of fintech felt a lot less like financial innovation and, well, a lot more like a primetime reality show. So, we're going to break down a really fascinating analysis that frames the week's biggest stories as a drama you just can't look away from. And honestly, that just nails it, right? We've got management shakeups that look like a messy public breakup, a new product launch that's part credit card, part casino game, and a company valuation that is just so wild it's hard to believe. So, let's dive into the first act. All right, first up, we've got a story about a company called Future Fintech. And if you think that name sounds kind of generic, just you wait until you hear about their latest plot twist, a complete change in who's running the show. So, what does this actually mean in plain English? Well, new people are taking over the company, and to do it, they've basically just printed a ton of new stock. So, for anyone who already owned a piece of Future Fintech, their slice of the pie just got a whole lot smaller. It is classic corporate drama. And the company's backstory? Oh, it is just bizarre. And yes, you are reading that timeline right. It started out as a fruit juice company. Since then, it's hopped from one hot trend to the next, from blockchain to supply chain finance. It's basically been cosplaying as whatever type of fintech company is in style. What a ride, huh? So when you see a move like this, a company swapping out its entire leadership and watering down its stock, what does it usually signal? Well, it's typically a flashing red light. It basically screams that the old plan completely failed and the new team needs a massive injection of cash, probably to chase yet another trendy, shiny object. And I love this comparison because it perfectly captures the company's identity crisis. Just like the band Weezer changing its sound every couple of albums, Future Fintech just keeps reinventing itself. And it really leaves you wondering, is this a serious long-term player, or are they just here for the chaotic ride? Okay, let's move on to our second story. This one's all about a flashy new product, a Bitcoin rewards credit card. But more importantly, it's about the quiet giants behind the curtain who are really pulling the strings. So, the headline here is a startup called Fold is jumping into the credit card game. Their big hook? Instead of earning airline miles or boring old cashback, you earn Bitcoin. And look, this partnership is a huge deal. They're being powered by two of the biggest names in payments on the planet, Stripe and Visa. But here's where it gets a little weird. The reward system isn't straightforward. It's completely gamified. After you buy something, you have to open their app and literally spin a digital prize wheel to see how much Bitcoin you get. It's been described as Chase Sapphire meets Chuck E. Cheese, which feels incredibly accurate. But that spinning wheel isn't the real story. The real story is a concept called the rails. Just think of Stripe and Visa as the railroad tracks of the financial world. Every single transaction, I don't care if it's for dollars or euros or Bitcoin rewards, it has to run on their tracks. And guess what? They get to take a small fee every single time. So for Visa and Stripe, let's be real. They could not care less if the reward is Bitcoin, Chuck E. Cheese tokens, or airline miles. It is completely irrelevant to them. Their entire game is to be the indispensable plumbing, the rails, for every transaction happening anywhere. And now for our third and final act, we've got the most audacious, most jaw-dropping story of the week. It involves Tether, the company behind the world's biggest stablecoin, and an ambition so big it almost sounds made up. The number at the heart of this story is just staggering. $500 billion. Yep, that is the valuation Tether is reportedly looking for. Just to put that into perspective, that would put them in the same ultra-elite club as companies like Apple or Nvidia. It's just, wow. And if you think that valuation sounds insane, get this. In 2023, Tether apparently made more profit than BlackRock, the largest asset manager on Earth. Their business model is shockingly simple. They hold billions of dollars in US T-bills. And with today's high interest rates, they're just raking in billions from the interest. It's a ridiculously profitable business for a company that, at its core, just issues digital IOUs. Okay, but here is the massive, massive catch. For a company that wants an Apple-level valuation, its financial transparency has been, let's say, murky at best. For years, investors and regulators have been begging for a clear, full audit of the assets backing their stablecoin, and they've just never really gotten one. And this quote just perfectly sums up the sheer audacity of it all, right? It's like your friend with a lemonade stand suddenly demanding a valuation bigger than Coca-Cola. Tether built an empire, no doubt, but now it wants the validation and valuation of a global giant, all while keeping its books pretty much closed. So, after all that drama, what are the big takeaways from this week's FinTech reality show? Let's recap what we've learned from each of these crazy stories.
First, from Future FinTech, we learned that a messy management change is often just that, more soap opera than actual progress. Second, with the Bitcoin card, we're reminded to always look past the flashy new toy and focus on the rails that are actually profiting. And finally, Tether's wild story shows us that gigantic profits don't mean much if you don't have gigantic transparency to back it up.
And that really brings us to the final question, doesn't it? In a world this chaotic, this unpredictable, and let's face it, this full of drama, it makes you think. When the line between solid financial innovation and a reality show gets this blurry, who do you actually bet on to win in the long run? The quiet builders of the rails or the loud, flashy stars of the show? It's definitely something to think about.